Okay. Shoot. All right. Here we go. Okay. Can that go away? Restart. Cost object. Anything that accumulates cost or that costs can be attributed to. Job order costing. Cost object is a unit in process here. An example of this is the Mountaineer statue. It is high product variety, low product income, goods are made to order, high differentiation from competitors, high profit margins, and many sales mix decisions. Process costing. The cost object here is the entire process. So cost object is not a unit, it's the whole thing. Examples of products that use process costing are pencils and peanut butter. There's low product variety, high product volume, goods are mass produced, low differentiation from competitors, very thin profit margins, and few sales mix decisions. The equivalent units for process costing is a way to measure incomplete or partially completed units. For example, a unit may be 100% complete for raw materials, but perhaps only 10% complete for conversion costs. The steps for finding equivalent units are separating the estimates into raw materials, which are usually added 100% at the beginning of production, and conversion costs, which is everything but direct materials, so essentially just direct labor and manufacturing overhead. DL and MOH convert the raw materials to finished goods, and this happens throughout the period. Process costing, equivalent steps, equivalent units, total cost to account for steps, weighted average. Step 1, find the physical units. Step 2, equivalent units, which end up on ending if on the balance sheets. There are two categories, incomplete or complete, where incomplete is ending WIP. So there's no beginning WIP for WA in terms of finding equivalent units. For step 3, we find beginning WIP plus costs incurred during period equals total cost to account for. Step 4, DM cost or CC cost equals total cost divided by equivalent units to date. Total cost equals direct material cost plus conversion cost. Conversion cost. Step 5, finally, total costs added that period per category. Step 4, cost. Remember, for weighted average, it's equivalent units as of today. For the process for equivalent units for FIFO, step 1, again, is find the physical units and put them in. Step 2, it's for this period. This period. So that means we have beginning WIP, which means stuff we started last time and finished this time. SNC started this time, finished this time. Ending WIP started this time, we'll finish next time. FIFO this stuff or do what it gives you. Step 3, do the FIFO. Step 4, cost incurred only in this period divided by total equivalent units for this period. So no beginning work in progress for FIFO equivalent unit cost. Total cost equals DM cost plus CC cost. Step 5 for FIFO, cost to complete beginning WIP. That's the costs incurred to finish building incomplete products we had at the start and spent more on those in previous periods. We add costs from WIP beginning to this. Cost of SNC units. Step 2, SNC units times step 4 cost per equivalent unit. Cost transferred out, add up beginning WIP and CC. Cost assigned to ending WIP is total cost minus cost transferred out. And finally, total cost accounted for is the sum of the costs transferred out and ending WIP. And we want to see that it equals step 2, total costs. 2 basic business strategies, product differentiation, and cost leadership. Basic business strat number 1, product differentiation, means you're a firm that is a leader because you do things differently. You have superior or unique products, and people pay extra for them. Examples are Apple and Lululemon. So, like, think more brands. Cost leadership, basic business strat number 2. You're a super efficient company, and people buy your products because they are cheaper than the brand names. Balanced scorecard, aka BSC. It's a representation of a strategic plan as a set of objectives, grouped into categories and linked in cause and effect relationships. BSC, objectives in order of what affects what. I guess that's affects, not effects. Whoops. Learning and growth. So that's the bottom of the period. That's what can we teach employees? Internal business, we ask ourselves, what do we actually do well? What can we improve on? Customer, how do we get and retain customers? And financial, that's like all of the ratios, like the financial ratios, like ROI and stuff. Leading measures, things, I don't know, I guess used in internal business. Lagging measures, financials, those are all behind. Making it succeed. What do we do to make all this succeed? We determine an objective and figure out how to measure that. And what is our goal? What is like what measure of the objective are we targeting? And what is our plan to obtain that target? So again, objective is your goal. Target is like the concrete version of your goal. So using data, not just like and like 100-meter dash times rather than saying, I want to be faster, which is a goal. Initiative, a plan. So you need to be creative here. Like, how will you see progress or not progress in working to achieve your target? And finally, I guess that's not there. Oh, that was initiative. That's your plan. Be creative. Principal, that's the shareholders or just the boss telling people what to do. Their goal is to profit the most possible, which is accomplished by participation constraints and incentive compatibility. Here they care about average pay. Participation constraint means the principal hopes to pay agent as little as possible, so decreasing costs to increase profit. Incentive compatibility, principal hopes to motivate agent to work hard using the least amount of pay. An agent is a person who acts or does business for another, i.e., for the principal, like a CEO to a shareholder or an employee to a boss. Just some terms to look out for here, which we'll cover right now. Risk averse, reluctant to take risks, and if the risks are controllable or not is a concern. Effort averse, must be incentivized to work. Incentive intensity, the more you get for a unit of effort, the more units of effort you give. Example, bonuses, stock options, stock grants. Incentive stock-based compensation, for main purposes and benefits. Motivation, communication, screening, risk sharing. Motivation here means encouraging people to work hard. There's 2 types, intrinsic and extrinsic. Intrinsic motivation comes from inside, like the ooey gooey. I like to read because reading's fun. Or I like to be nice because being nice is just the nice thing to do. Extrinsic motivation comes from the outside, and this is where the crowding out effect occurs, which we'll cover on the next thing. But extrinsic motivation would be like getting paid to do labor rather than just getting like volunteer hours or a pat on the back. The crowding out effect, extrinsic incentives can destroy intrinsic incentives. Good example of this is Pizza Hut doing it was called like I like to read or something, where if you read a certain amount of books, you got free pizza. This led to quote unquote fat kids who hate reading, end quote. Incentive stock-based compensation, the next purpose or benefit is communication, which means here that we explain the principal's desires effectively. Next purpose benefit is screening. It's very important because when we know we have a better deal with option A than option B, we want to take option A. Finally, last purpose benefit, risk sharing. Principals can reduce some of their risk to employees by giving them contingent-based contracts. The controllability principle. Workers should be compensated based on measures over which they exercise a high degree of control. Controllability principle, 3 ways we construct contracts in this manner then. Using input, output, or outcome. Input. What someone puts into their job. It's difficult to measure, but it's easy for the agent to control. Like, let's see. If you're taking an online class, sure, it's hard for the professor to see how many hours you actually put into taking that online class, but it's easy for you to decide how much effort you're willing to put in. Output. Amount of work actually done. That's easier to measure than input, and it's still relatively easy for agent to control. Like, you got 5 modules done in one day on your online class. And outcome. The end result of input output, still really easy to measure, but very difficult to control. Like, you did 5 modules in one day, but did you actually learn anything? Did you end up getting an A in that class? We don't know. Budget. An estimate of activities that'll be carried out over a specified future period of time. Master budget, also known as static budget. Giant spreadsheet of all your budgeting, big plan, target. But it's always, always wrong. Budget, 3 standard steps to set it up. Identify goals and objects, determine activities that will be carried out to meet step 1. So that's the cause and effect relationships of processes shown in the balanced scorecard in action. Oh, and the number 3, I missed it. Whoops. Budget, the purposes of it. Benchmark, communication, coordination, motivate employees by giving them a target. What does a benchmark mean? That's something a firm can compare actual performance to. Or like, it's like a target, like, or a measure where you're looking at your times from that 100-meter dash and you're saying, oh man, my best time was X, and I just got time Y, and time Y was less than X. So I need to do more to get back up to my personal best time X. Budget cycle. For all budgets, you should always start with sales and then work backwards. How to budget. Like I said, work backwards. Start with the budgeted sales in units, not dollars, and look at the finished goods T-chart. Flexible budgets. Adjustable static master budgets based on actual production or data. So basically change almost everything in the master budget or you're able to change almost everything from the master budget based on units actually sold or changing expectations. Everything but fixed manufacturing overhead changes here, guys. So FMOH stays the same. Human considerations of budgeting for good or bad targets, and bad meaning, is it too high or is it too low? And also motivation, as in targets that are controllable or uncontrollable. And here I cover more of the PowerPoints than his lecture notes. Job order versus process costing. Job order costing. The cost object is the individual job order or unit. Track cost individual units. Each unit gets different costs. High product variety, low product volume. Goods made to order. High variable costs. High differentiation from competitors. High profit margins. Many sales mix decisions. Process costing. Cost object is the entire process rather than just a single unit, i.e. a whole period's worth of work or a whole group of units. Averaging costs. Low product variety, high product volume, goods mass produced, high fixed costs, low differentiation from competitors, thin profit margins, few sales mix decisions. Average cost per unit in process costing. That's total costs incurred divided by number of equivalent units. And we know total costs incurred, but we don't know equivalent units until the end of the period. Equivalent units versus physical units. Equivalent units, a way of measuring work on partially completed units, measured as quantity of physical units times the percent of the weight completed, which can differ in terms of direct materials or conversion costs. Physical units is an actual unit, even if only partially completed. 3 complications to equivalent unit calculations. Non-immediate direct materials, but we can fix this pretty easily by carefully calculating equivalent units for DM. Another issue is multiple departments. Another easy fix, just have separate problems for each department. And the last issue, weighted average versus FIFO, that's a bit more complicated to fix. Weighted average versus FIFO. Weighted average, all costs are mixed together. FIFO treats old units and new units separately. Jeez. Okay, management control system. A set of rules, activities, and information that an organization uses to make and execute planning, control decisions, and to direct employee behavior effort toward achievement of organization's goals. Formal controls. Explicit rules, procedures, safeguards, and incentive plans employed in the organization. Includes cost accounting system, HR management system, quality management system. Cost accounting system aggregates, monitors, and reports information about revs, costs, and profitability through the use of forms, processes, controls, and reports. HR management system helps the org manage all aspects of human resources, including compliance with employment laws. Quality management system records and tracks product quality, including production, defects, and customer service data, such as late deliveries and product ratings. Informal controls. An organization's norms, morals, ethical values, and shared culture, which all guide employees' behavior and strategic decision making. Controls can be categorized as behavioral controls or output controls. Performance measurement. Process of collecting and analyzing information about org performance and comparing it to expectations and goals. Most effective when an org knows desired results. Results can be clearly measured in a timely manner, and results are attainable and controllable by employees responsible for that performance. Human implications of performance measures. 4 steps of establishing effective performance measures. Identify goals. Create performance measures that closely align with those goals. Create specific performance targets for employees to reach related to each performance target. And to motivate workers, assign rewards and recognition to employees based on their achievement of these performance targets. Common financial reporting measures, ROI, RI, and EVA. But apparently, he said EVA won't be on the exam, so I'm not going to worry too much about that one. ROI, return on investment, commonly used measure of short-term financial performance. Measures the cost of money made on an investment relative to that investment's cost. It's defined as a measure of profit or operating income divided by a measure of investment. Comparable across investments in projects the org may undertake. To increase ROI could either increase revenues or reduce costs. Also can be defined by the DuPont method. So ROI calculated by DuPont method deconstructs ROI into return on sales and asset turnover, helps to determine how each aspect of the business is performing. Calculates ROI as a product of return on sales and asset turnover, i.e. return on sales times asset turnover. So we need to know OI, sales, and assets. Return on sales. Profit earned for each dollar of sales, calculated by OI divided by sales. Asset turnover. Calculates total sales divided by average total assets of a subunit, i.e. sales divided by assets. RI, residual income, is a measure of a subunit's or organization's financial success. It measures the amount of net income from an investment in assets that remains after the investment has been recovered. RI equals OI minus imputed investment cost. Imputed investment cost, or IIC, is the implicit cost of using an asset. So that's the minimum rate of return times investment value. Minimum rate of return is also known as required rate of return or cost of capital. It's the lowest acceptable amount of earnings from an organization's investment in assets. RI versus ROI, both are designed to help organizations evaluate the profitability of projects, thus focusing on either ROI or just ROI, may cause managers to make different choices about whether to pursue a new venture. Example, focusing solely on ROI may give managers a distorted view of the benefits of a new project and make them less inclined to invest in it, since new projects decrease ROI since it focuses on the initial investment. Data analytics stuff. Ask the question, master the data, perform the analysis, share the story. EVA, we can skip that, but yeah, we're skipping it. WACC, weighted average cost of capital. It's the after-tax average cost of all long-term investments. Transfer price, the price one business unit charges another business unit within the same org for its product or services. Most commonly used by orgs that are vertically integrated, meaning organizations where the output from one business unit becomes the input for another unit. Goals when establishing transfer prices. Motivate business unit managers to exert a high level of effort. Promote goal congruence both across the business units and within the org as a whole. Provide a mechanism for evaluating and rewarding business unit management for effective decisions. Methods for setting and calculating transfer prices. Market-based transfer pricing, cost-based transfer pricing, hybrid transfer pricing. Market-based. Subunit management sets a transfer price based on the prices outside suppliers are currently charging. Cost-based. Management sets a transfer price that allows the subunit to recover its costs. Hybrid. Transfer price takes into consideration both the market price and the production costs. BSC, Balanced Scorecard. Representation of a strategic plan as a set of objectives grouped into categories and linked in cause and effect relationships, like a strategy map. For objectives or perspectives. Learning growth, that's how we sustain our ability to change. And how will that improve via our employees? Internal business. What business processes must we excel in to satisfy our shareholders and consumers? Consumer. How should we appear to our consumers? And financial. How should we appear to our shareholders? Leading measure. Variable whose change is associated with a later change in another, probably lagging variable. Example, on-time delivery leads improvements in customer satisfaction. Lagging measure. Variable whose change is associated with a previous change in another leading variable. Example, improvements in customer satisfactions lags on-time delivery. What leads the customer perspective? Internal business. What lags the customer perspective? Financial. Objective. The dimension of performance that the manager wishes to improve, often stated in general terms. Measure. Source of data that can be used to assess performance on an objective. Target. A level of the measure against which performance will be compared to determine success. Initiative. A plan or strategy for achieving a target level of performance. Making it succeed example. Running. Objective. Run fast. Measure. My time in a 100-meter dash. Target. Faster than my last time. Initiative. Practice, practice, practice. Another example. Objective. Have high customer satisfaction. 5-point scale answering the question, how likely are you to recommend our product to a friend? Target, hopefully an average score of a 4 out of 5 or higher on the measure. Initiative, promise 100% satisfaction or your money back to improve customer satisfaction. Principal, person who assigns another, the agent, to undertake a task, like a boss or an owner, shareholder. Agent, one who undertakes a task on behalf of another, like a CEO to shareholders or an employee to a boss. Moral hazard, circumstance where an agent is shielded from the full impact of their decisions. Risk averse, reluctant to take risks. The higher the incentive intensity, the more we have to pay to compensate for the risk. Effort averse, must be incentivized to work. Examples to counteract: bonuses, stock options, stock grants. Incentive intensity, sensitivity of pay to a performance measure, the slope of the pay performance function. Principal's goal, participation constraint, incentive compatibility, where participation constraint is where we pay the agent as little as possible, but enough to get the agent to actually take the job and accept the job. Incentive compatibility, motivate the agent to work hard while doing the job. Purposes of incentive compensation: motivation, communication, screening, risk sharing. Motivation encourages people to work hard. Decision influencing role of accounting. Intrinsic versus extrinsic motivation, crowding out effect. Communication, explain the principal's desires. Screening, attract a particular type of agent. Risk sharing, spread out the risk between the principal and the agent. And here begins what he said that was important, either throughout when he was actually lecturing or on review day. Things he said would be on exam. Only one question each for equiv units, FIFO versus weighted average. And what would happen to cost of goods sold if we overstated how far along ending WIP was? So redo something, assuming 90% complete instead of 60% complete. Performance measurements, process costing, weighted average versus FIFO, budgeting. Things he said wouldn't be on there. EVA and the exam will be a lot easier than the homeworks. Balanced scorecard objectives, learning and growth, internal business, customer, financial. Making it succeed, objective, measure, target, initiative. Performance measurements question. A company uses this as a performance measurement. Why is this a good or a bad one? Here's a scenario. Give me 3 reasons why this is a good, bad thing. Is a bad performance measurement better than no performance measurement at all? All right, now these are the buzzer questions from review day. So Wesley owns a business where people can spend time with service dogs when they feel depressed, anxious, or irritated. Wesley aims for high consumer satisfaction. After each consumer's visit, they are asked to rate their experience on a scale of 1 to 10, with 10 being the highest score. Wesley aims for an overall score of 9 out of 10 or better. This could be defined as his target. Which balanced scorecard perspective focuses on net income and similar metrics? Financial. Which perspective of the balanced scorecard framework focuses on measuring the org's ability to innovate, improve processes, and learn to create long-term growth and sustainability? Oh, shoot. Learning and growth. Excuse me. My cat got a little too excited about the bird live stream I had on the TV. Leading and lagging indicators. Leading indicators help predict what is to come in the economy, and lagging indicators are the effects of an expansion or contraction in the economy. KPIs for the 4 objectives in balanced scorecard. How can managers manage earnings or commit fraud using process costing? Mess with the percentage of completion of work in progress items. If you crank that number up, oh my gosh. All right. If you crank that number up, then increase the cost of inventory not sold yet. So that's a temporary boost to net income for this period, since we don't really have cost of goods sold until the goods are actually sold. But however, while that increases net income for this period, once that inventory is actually sold, net income is decreased more then. So, yeah, it's nice for right now, but if you mess with that percentage too much, it's going to bite you later. Which financial ratio measures a firm's ability to generate sales from its assets? Asset turnover. Asset turnover. Sales divided by assets. Return on sales. Oh my gosh. Ooh. Return on sales. Net income divided by sales. Return on investment. Net profit after taxes divided by total assets. Residual income. RI. Net operating income minus parens average operating assets times minimum required rate of return, close parens. Job costing versus process costing. Variety. Job costing has lots of variety. Process costing has no variety. Sales. Job costing, little sales volume. Process costing, lots and lots of sales volume. Profit margins. Job costing has higher margins. Process costing has very slim profit margins where profit almost depends on the volume of units sold. Real life examples, job costing, Deloitte, process costing, Tigeraga, or Pepsi for pencils or bottling plant. Bonuses and promotions are examples of extrinsic motivation. What's an example of intrinsic motivation? Happy, touchy-feely desire to do well, to do your best. Extrinsic motivations does what to intrinsic? Crowds it out. And this is what I was talking about earlier, the Book It program at Pizza Hut. What economics model describes the relationship between owners and those hired to work on behalf of the owners? Principal agent model. Who's who? Campus Styles produces custom t-shirts. The firm's budgeted direct costs per t-shirt are as follows. What is the flexible budget for direct materials costs in October? That's $6,000, in which we got via the direct materials cost per unit times the actual production. Since this is a flexible budget, we use actual production. Point of a master static budget. Overall goals doesn't change. Point of a flexible budget, so you can actually make changes. How many units should they produce, i.e. production budget? Expected sales plus ending inventory minus beginning inventory. And direct materials purchasing budget. Okay. Units to be produced times direct materials in units plus ending inventory of DM minus beginning inventory of DM. Thanks.